couple of short videos to provide some insights as to how do you forecast not only the income statement, balance sheet, but also statement of cash flows in case you need it for your career. And so with that, I'll go ahead and share my screen and we'll get started. So this relates to balance sheet forecasting. As we talked about in our first video, the sequence in which you forecast is critically important. You have to start out with the income statement. And within the income statement, really focusing on net sales is critically important because that net sales is going to be drivers in many of their line items within the income statement, balance sheet, and statement of cash flows. But after we have our income statement forecast complete, then we can move on to the balance sheet. And with the balance sheet, we're actually going to start from the bottom up. And so think about how the balance sheet is organized. It's assets, liabilities, and then equity. And so the first thing that we're going to forecast is our equity section of our balance sheet. And as we talked about before, it's important to develop and document your forecast assumptions. And so what I like to do is that I like to assume no new external share issuances. And so there may be internal share issuances for executive compensation, but in order to keep our forecast consistent over the forecast horizon, I really want to focus on operational results, not capital allocation decisions, such as issuing additional shares. Those are very unique instances that could dramatically input our earnings per share and then our overall forecast that may detract from really the operational movements within the forecast. Net income, especially within the equity section, is going to be obtained from the income statement. Again, that sequence is really important. You have to forecast the income statement because there's going to be items to that income statement that are then going to feed into the balance sheet. And we're going to see that right off the bat within the equity section. We'll look at our dividends. If your company pays a dividend, we're going to usually base that dividend increase based upon trend. And usually for most companies, there is an observable trend there. Comprehensive income. And so we talked earlier in the semester about the statement of comprehensive income. That's net income from the income statement plus or minus unrealized gains or losses. Those are non-operational in nature. And so just again, to keep our focus on the operating results of our forecast, we're just going to assume that that's going to be equal to the most recent fiscal year, or said another way, flat to the prior year. Next is share repurchase activity. So share repurchase activity is that we will base that upon trends because a lot of companies do have annual activity. This isn't unique in nature like share issuances. Share repurchase activity, some companies, if they have a stated trend of trying to repurchase a certain amount of shares every single year, we do need to factor that into our forecast. So for example, at Energizer, I always like to repurchase shares to offset dilution from executive compensation, those internal share issuances, right? And so that would have definitely been an observable trend. And so we'll take a look at that trend to see whether or not it makes sense to contemplate that into our equity section forecast of the balance sheet. And so let's go ahead and get started. We, again, pull our historical financial results. The first thing that we're going to measure and look at is the par value of preferred stock and common stock, and then also the paid-in capital, right? And you can see that there is an observable trend on preferred stock, 0, 0, and 0, and so forecasting that to continue. Same thing with the par value of common stock, right? This shows that historically there have been no new external issuances, and so we're going to assume that trends are going to continue. Just keep that dollar amount flat over the forecast horizon. There has been some movement in paid-in capital, and so that's likely due to movements in the executive comp and things like that, but it's been pretty minor. And so just for consistency's sake, what I'm going to do is that I'm just going to leave it flat with the most recent fiscal year. Because some years it's up, some years it's down. But those movements haven't been material. And so for simplicity's sake, I'm just going to keep that equal to the most recent fiscal year. Again, that's going to allow us to really focus our forecast on the operational aspects to what's driving our forecast. And so now we've completed, the preferred, common, and paid-in capital sections of our forecast. Now we can move down to a roll forward of retained earnings. And remember, retained earnings is last year's ending becomes next year's beginning. And so the first thing we'll do is that we'll look at the most recent fiscal year, ending retained earnings. That becomes this year's beginning. This net income, well, we pull this from the income statement, right? So one of the reasons why we have to do the income statement first, well, it's because you can't do your balance sheet forecast unless you have your income or net income from your income statement. And so that's pulled directly from the income statement. Next is dividends. And so with dividends, you can see, looking at trends, is that this company has continuously increased their dividend payments to their shareholders around 5 to 6%. And so what we'll do is that we'll just plug in a 5% growth over the 3-year forecast horizon. That allows us to calculate our dividend payments to our shareholders. Now, new accounting pronouncements. Again, trying to keep it consistent year to year, or at least versus the most recent fiscal year, we're going to assume that accounting's not going to change. There's not going to be any new accounting pronouncements, so just plug in 0. And so that allows us to calculate and roll forward our retained earnings balance. Next thing is accumulated other comprehensive income and loss. We talked about this earlier. Is that comprehensive income? It's net income from the income statement plus or minus changes in unrealized gains. Just like the income statement gets closed out to retained earnings, changes in comprehensive income gets closed out to the equity section here as well. And so this is the change in unrealized gains or losses. Impossible to predict. And so what we're going to do is that we're just going to keep this flat each year with the most recent fiscal year. And then finally, treasury stock. Treasury stock represents share repurchases. So we'll call it share repo. And you can see over the last couple of years, they've consistently repurchased between 8 to 10% of their stock. First place I would look is at an investor presentations, year-end earnings press release, earnings call transcript to see if the company plans to continue repurchasing stock. And so in this instance, they do, and they continue to repurchase about 8% of their shares outstanding. And then that allows us to calculate the dollar impact. Okay. And so now we've completed the equity section of our balance sheet. And now we can move on our way up. And so next is liabilities. Within liabilities, in our forecast of the liability section, we're going to start using some of our ratio analysis. So in order to forecast accounts payable, we're going to use our days payable outstanding, or DPO, to back into our accounts payable forecast. And just like the income statement, remember that internal consistency? We assume that debt levels will remain consistent with prior years. So no increases or decreases in debt. Now, you can look within the 10K, the debt footnotes, to see if there's any scheduled maturities. Even if there are scheduled maturities, you can assume that they're just going to refinance and keep debt levels flat over the forecast horizon. Because a lot of times publicly traded companies, if their debt comes due, if there's a maturity, what they'll do is just simply refinance it, keep debt levels consistent or flat. If there's tax items within your liability forecast, again, this is why we have to complete our income statement forecast first. We're just going to assume that those tax items are going to change equivalent to our pre-tax income or our net income growth rate changes as well. And so we'll take those percentage changes from the income statement and apply those to tax liability items. And then there's going to be other items. So oftentimes other non-operational items. Just to keep it consistent and keep it really focused on operating results, we're going to assume that these other items are going to be equal to the most recent fiscal year or flat to the prior year, Or if there's an observable trend, we can use that observable trend. And so debt. First, so as I mentioned, we're going to assume that debt levels are going to stay flat versus the most recent fiscal year, both current or short term as well as long-term debt. Accounts payable. Well, I mentioned this before. This is where we're going to use some of our ratio analysis. We'll set some targets for our days payable outstanding, and then that's going to allow us to back into or calculate our accounts payable forecast. Tax items. Well, tax items, we're going to look at how net income grew on the income statement. And so we go back to our income statement forecast. Net income was growing at about 6.5 or 6.4% over the 3-year forecast horizon. And that's what we'll assume that our tax items will grow by as well. And then the other, so deferred and other liabilities, business acquisition liabilities. We really don't have a good basis, a good operational driver for these. And so just to keep the focus on the operating changes of our forecast, we're just going to assume that these items are going to remain consistent over the forecast horizon. And so that allows us to now complete our liability forecast. The final step of the balance sheet is our assets. And so with assets, again, we're going to use some of our ratio analysis. We're going to use days sales outstanding and days in inventory to calculate accounts receivable in our inventory forecast, really looking at those trends and objectives within those key ratios. Other, just like we handled other within liabilities, we'll assume that they're flat to prior year levels, or if there's an observable trend, we'll use that. PP&E, plant, property, and equipment. Right? So if you're going to grow sales, it has to be supported by investments. And so we'll use our sales forecast to drive our PP&E forecast. Right? So this is going to show investments to increase our manufacturing capacity to support our increase in sales. Other, again, we're just going to look at an observable trend or keep it flat versus prior year. And then so that assets equals liabilities and equity, we may need to plug, and our plug is going to be our cash line item on our balance sheet. So again, accounts receivable and inventories, we're going to use our DSO and DII ratios and targeted levels with those metrics to back in to calculate accounts receivable and inventory. We'll come back and plug cash in a bit. Other, we're just going to look at trends that's remained pretty consistent, around 27 to 35. We'll just keep this consistent with the most recent fiscal year. PP&E, well, in order to support that 5% sales growth rate, we're going to grow PP&E by 5% over the forecast horizon. And then these other items, we'll look at trends, see if there's an observable trend. If not, we're just going to keep it flat versus the most recent fiscal year or year 2020. In this example, again, this allows us to keep really our focus on operating items instead of trying to guess as to what's going to go on with goodwill or other assets where there's not an observable or known business driver. And so finally, we need to make sure that assets equals liabilities plus equity. And so that's going to require a plug, and our plug in this instance is going to be cash. So that assets equals liabilities plus equity, right? And so that allows us to complete our balance sheet forecast. Next video will be focused on cash flow.